So first things first, if the problem is mortgage rates, how do we get to lower mortgage rates? Well, we get to lower mortgage rates by making sure the Fed is happy with inflation. Now, mortgage rates have always followed inflation. Why? Because mortgage rates are a long-term bond that someone holds. Now, if you were holding a mortgage, you're getting fixed payments every month. So if inflation is moving higher or anticipated to move higher, before you take on the obligation of that mortgage, you want to think about what's the rate of inflation, because inflation is going to make prices go up. If inflation has risen, that means that prices will go up faster. So that fixed payment that I'm getting every month will lose value or buying power or erode more rapidly. Now, if inflation's low, well, then that buying power will remain intact better. So lower inflation, typically lower long-term rates like mortgage rates. Higher inflation and mortgage rates typically have to go up. And through almost all of history, that's exactly what's happened. And if we take a look at the last several years, you could see this. Now, the line that you see on the bottom here, this line that's kind of in the pink color, that's inflation. The blue line on the left here that you see, those are 30-year fixed rate mortgages. Now, notice what happens. Inflation moves up. So what do mortgage rates do? They go up. Well, inflation comes down. What do mortgage rates do? They go down. Inflation goes sideways. Mortgage rates go sideways. And then you get this QE period where things were a bit distorted. But we come out of QE. The Fed creates all this inflation along with the government spending, and inflation goes up. So what do mortgage rates do? They go up. Then inflation subsides a little bit here, and so do mortgage rates. Well, inflation goes up, so do mortgage rates. Inflation comes down, so do mortgage rates. Hey, man, this is kind of like having tomorrow's newspaper. And for most of history, it was, until something very peculiar happened a few months back. I'll tell you what, I was full admission here. At the beginning of the year, we thought inflation was going to come down. Now, we happen to be right. When inflation was at 9%, we said, hey, by the summer of 2023, and we even nailed it. We said June of 2023, we see inflation at around 3%. Well, guess what? It came down to exactly 3%. But because we thought that inflation was going to come down, we thought mortgage rates would follow. I said mortgage rates should be below 6%, in the fives. But boy, was I wrong. Because even though inflation came down exactly where we thought it would, mortgage rates went in the opposite direction. So what the heck happened here? What went wrong? Why did we see a divergence from what we had been accustomed to all throughout history? And the reason? Well, reason number one was money flew out of bank deposits. Now, the Fed had hiked rates so much, they gave depositors an alternative. Right now in the United States, if you put your money in a bank deposit, you're getting about 0.5%. But if you simply moved it to a money market, today you're getting over 5%. So we've seen money come out of banks and into money markets. See, these are the money market accounts. You can see them going up as deposits are fleeing. So why is that important to us? Well, because when a bank holds your money on deposit, they take that money of yours and they invest it in things like car loans or personal loans or business loans. Well, by doing so, they get a very nice rate of return. They pay you 0.5%, and they make 5, 6, 7, 8, 9, 10%. That's a great business. But they can't put all of their eggs in that basket, because if you want your deposit money back, they can't go back to the person they gave the car loan to and say, hey, sorry, I need the money back. That just doesn't work. So they put some of their money in those loans, but they also put some of it in things like mortgage-backed securities, which give them a higher rate than they're paying the depositor. But those mortgage bonds, what they do is they're very liquid. They're a bond that they could sell. And as the deposit money started to flee, banks had to sell those mortgage-backed securities. And that selling caused mortgage rates to rise. Then combine that with, thanks to the Fed, the failures of SVB, First Republic, and Signature. Those were all taken over by the FDIC, the Federal Deposit Insurance Corp, and all the assets like mortgage-backed securities were sold. And when were they sold? Right over the summer when rates started to go up. So these circumstances were very negative for interest rates. The good news is you could see here that this has finally started to level out. So one bit of good news, but there are also a couple of other things that happened over the summer. You might recall the debt limit crisis. Well, that debt limit crisis was solved by an agreement to raise the debt ceiling by $270 billion more than anticipated. So that's additional spending. Now, we don't have the money. So what do? You sell treasuries. And when treasuries are sold in mass quantities like that, it causes, in order to get appetite from people to buy it, you got to offer them a higher yield. And when rates on treasuries go up, they also go up on mortgages. And then the hits keep coming, right? Remember the downgrade from our credit rating from Fitch? They took the US credit rating down. And just like a customer, if their credit rating is a little worse, the rate's a little higher. So that hurt rates. And while all of these negative things had occurred, the biggest one has been the Fed and this guy, Jerome Powell, and other members of the Fed who put upon us all this inflation and created it. But now they have been maniacal in trying to kill inflation that they caused. So they were the arsonist, and now they're trying to be the fireman. But they don't realize they're doing a little bit too much damage. And that's probably because Jerome Powell and many others of the members of the Fed are not trained economists. Look it up. This man's not an economist. He's a lawyer. Now, I don't say that lawyers can't be very intelligent. Of course they can. But if someone were being put on trial, you wouldn't want an economist representing them. You'd want a lawyer. So when it comes to the economy of the United States, is the best person to have a lawyer or perhaps a trained economist?